What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked #1 on Wall Street in the 2024 All-America Institutional Investor Research Survey. I'm joined by Stephen Gregory, Head of Quantitative Research at Piper Sandler.
Michael, good to see you. You've been traveling, meeting clients, talking to people. But before we jump in, you were just telling me about some other exciting news this week.
My daughter, my oldest daughter, who is now a senior in high school, yikes, she is in a cappella group. She's been in that for a few years. And their a cappella group sang the national anthem at Yankee Stadium.
Which is amazing.
She was on the field. Now, it wasn't the literal house that Ruth built, but it's the renovated new one down the street. So yeah, it was super cool.
So cool.
Seeing her on the big screen on the field. I was telling her, grab a little bit of that dirt, bring that home, sprinkle it somewhere for good luck. They sounded phenomenal. And I mean, what a special moment. What a proud dad moment for me, for sure, and my wife. All right, how about it? We listened to it. It's only about a minute long, so hopefully you guys don't mind. I'm pretty proud of it, and I think they sound amazing. Listen in. There's nothing more American than this.
To be on the field at Yankee Stadium is not something many people get to do. And then to sing the national anthem is just even beyond that. So
yeah, you could probably appreciate this. Maybe you've had a couple experiences like this. To me, I've found some of the most special moments with your kids are, of course, seeing them succeed at something like this or do something special. But when it overlaps with something that you yourself was part of your childhood, obviously, I grew up with the Yankees having quite the all-star team for a number of years and going to Yankee games. So to combine my daughter, that special moment for her with something that's special to me, being a huge, longtime Yankees fan.
Yeah, the overlap of your interest and her interest, it's a special moment. So congrats to you guys.
I've gone to a bunch of concerts with my daughters, and their taste in music is quite different than mine, although there is some overlap now. I could say I know a lot of the artists now that certainly all three of my girls like, and they've dragged me to their concerts, and some of these artists are really good. I've been to a Gracie Abrams concert with my daughter at Radio City. I've been to an Olivia Rodrigo concert with my other daughter, and they're pretty talented artists, and I've come to like their music as well. So I like to embarrass them sometimes when I drop them off from school and blast the music.
You're officially cooler than I am then. I've heard some of those names. I am a little bit in the know, but definitely not enough, especially considering I have kids too. I should be more up on this stuff. Really exciting news. We have an exciting week in markets coming up. There is an onslaught of important macro data coming out and Fed meeting.
Yeah, next week is a busy week on the macro front. Beginning of the week, we kick off with Monday with Empire Fed PMI. So that'll be really the first macro data point we'll get for the month of September. When we get macro data, I don't know if sometimes people realize this, but a lot of the macro data really is published with a lag. So I think about GDP tends to come out a couple of months after the period in which it's actually reporting. Retail sales data we're getting on Tuesday, but that's for the month of August. And then we'll be getting some other inflation data, import prices, export prices, the NHB index. So that'll be another leading economic indicator we follow. Again, that's for the month of September. Obviously, we're getting the middle of the month, but it's fairly recent. So that'll probably cover late August into early September. Building permits, housing starts. We're getting a deluge of housing data. PMI data. I think we get the Philly Fed also later in the week on Friday. And of course, on the 17th, We will have a Fed meeting with a updated dot plot, and likely Stephen Myron will have his dot in there. So we'll see where things shift. I think what the Fed is going to do is largely expected to be a 25 basis point rate cut. And while we're unlikely to hear any material commitments from Powell on what the Fed is going to do going forward, the dot plot certainly will serve as some leading indicator of that. In the past months, he has continued to refer to the dot plot, talking about that they're going to do two cuts. That's why I think for much of the last several months, the market's really not gone below pricing in at least two cuts this year. And so obviously the dot plot could change that, and it's likely to reflect probably some more dovishness than the prior dot plot. So that'll be the data point to watch here. And then, of course, oftentimes when Powell opens his mouth on these press conferences, he does sound quite dovish. So we'll see. We'll see what happens. I've noticed a pattern in the last several meetings, going back a couple of years actually, is that markets usually rally while he's talking. Because again, I think he often sounds fairly dovish. And then as soon as he's done, I remember the last couple of meetings at these press conferences, the market started to sell off right away. So not a forecast, but just an observation.
Definitely a big week ahead. And you brought up the Fed and what's being priced in. So that's what investors are thinking in aggregate. And you were talking to a bunch of investors this week. Was that a conversation that came up a lot? And what's your view? Should the Fed be cutting?
Yeah, many of the questions today are surrounding long rates, the yield curve, what the Fed's going to do, what they believe the Fed should do. Again, at the end of the day, it's not what we think they should do or anyone thinks they should do. It's trying to figure out what they're going to do. So a lot of questions around there, particularly with the context of the soft jobs data we've seen. We ended the 10-year, I think we touched just below 4% at one point this week, but we ended the week at about 4.06 on the 10-year. So fairly at the low end of the range we've been in for the last 2 or 3 years. So yeah, a lot of questions around that. A lot of questions around labor. This week we had inflation data, which again, wasn't like the prior month. It wasn't good inflation data, but the reason I think the market responded positively to it because it was in line with expectations, which was the same situation last month. And if we got this type of inflation data 2 years ago, the market probably would have sold off, because I think there just wasn't as much expectation and much transparency in terms of what was going on with inflation. And of course, there was much more of a broad-based story back then, whereas today, really people are focused in on the whether or not we're seeing any spreading out of the impact of tariffs flowing into inflation. And it is creeping in, but again, it's been largely expected. And we often say happiness equals outcome minus expectations. And I tweeted a chart this week after the CPI data, which was Bloomberg's Inflation Surprise Index, which has been trending down for the last couple of years and rolled over again this week because, of course, we got the PPI data, which was lower than expected. And perhaps that's really the most important data. It's not actually the actual macro data, but it's how that macro data come in relative to expectations. And certainly there were expectations for a pretty warm CPI print, which we got. So nothing earth-shattering or surprising to the negative side. And so that's an important part of understanding what's going on, as opposed to just harping, look, inflation's picking up. Well, if people expect it to pick up, you could argue it's reflected in markets and it shouldn't cause any major disruption. And that's what we've seen.
You're right. Expectations play such an enormous role in markets. And I think what you brought up is interesting because I don't think a lot of people often look at it that way. So you mentioned softer jobs data. Was that a big topic with investors this week? And what are your thoughts on that as equity markets continue to rise?
Certainly, as we typically see, you get some important data now 2 months in a row to catch people's attention. We got the big payroll QCW revision, which was pretty sharply negative. I think it was one of the biggest negative revisions in history. I saw a bunch of people post that data, and I always like to normalize data, right? Because I mean, the labor market today is bigger than it was in GFC, and population's bigger. So looking at these raw numbers, I think loses a little bit of context there. But nonetheless, it was a big number. But again, it was expected. Like, I think some people were surprised that on that day, this huge downward revision, markets really didn't respond whatsoever. And again, I think that was because it was largely expected. The consensus on the street, everyone had some big negative number. Nobody was going to get it exact. But nonetheless, it wasn't really a surprise. So markets really didn't react. It just maybe furthered the narrative and gave bears on the economy more things to point to, or bulls on the Treasury market, more things to point to. And so whether the labor market is cooling at a faster pace today is certainly a discussion. Not a ton of fear right now around recession, but that can change with one data point, as we've seen so far in the last couple of years. But definitely one question that we've been getting a lot, and something we've been talking about for about 2 years now almost, is I think there's some confusion or some concern about what is going on in the labor market and how that's sending down interest rates. Yet the stock market is more or less celebrating that. And I think that's confusing some people, because I think there's this notion that a weak labor market should mean weaker stocks. And while that has often been the case over the last 30 years, it's not always the case over the last 60, 70 years. There's plenty of precedent of stock markets going up amidst rising unemployment. And the part we've focused on for the last couple of years now is highlighting that one thing this market and economy need is lower rates, to help all the lagging parts in the market and the economy, from housing to real estate, commercial, to smaller companies that are bearing the brunt of higher interest rates, to low-income consumers that are paying the higher borrowing rates because the short end is elevated. So every time, and I would say in this cycle, it's disproportionately large. Every time we see rates come down, really for any reason, even employment weakening, it provides some hope that there's relief as well. It kind of offsets, it's not just bad news that employment is softening if rates are coming down. And it's kind of this arguably perfect balance we have right now, because the labor market has softened, and it's been softening for a couple of years now. It's just more evident to everybody now that with all these revisions, but it's happening at a glacial pace. Again, there's been no shocks. There's been no surprises of any material value. And so the softness in the labor market gives you lower interest rates, which, is why we've seen small caps do well and see some outperformance of the last couple of months, which is why real estate and housing stocks have outperformed. And this goes to, I think, a really important point. I've seen a couple of people post about how the bond market is reflecting what they call rising recession risk or weakening labor market risk, because the 10-year has been coming down. But at the same time, they point to the equity market going up and argue that, well, the equity market's ignoring it. And I couldn't disagree more of that conclusion, because number one, if you look at the bond market, I'm not sure that's actually entirely correct, because if you look at credit spreads, they have not really widened in any material manner, reflecting risk of recession. So we do have lower interest rates, but we don't really have wider spreads. That means that drop in rates, from whatever reason it's being catalyzed by, is not necessarily creating more risk. And I think it again goes back to the point I made about housing and smaller companies benefiting from lower rates. And at the same time, to say the equity markets are not reflecting it because the S&P's up or the NASDAQ up, I think again is just a gross misunderstanding of what is actually going on, and not even a good representation to answer that question, because look at some of the best performing names in the last several weeks as interest rates have come down. Home building stocks, housing related stocks, names like Rocket Mortgage and Wayfair, small caps, even some lower quality, highly shorted names with a lot of variable floating debt. They've benefited. So, I don't know what clear evidence you need to point out, or I need to point out, that the equity market is absolutely reflecting this. Just because it's not seeing it in a negative way doesn't mean it's not reflecting it. I think it's seeing it in a positive way, because again, the employment weakness we've seen hasn't been a shock, hasn't been rapid. So we're in this kind of somewhat balanced macro backdrop right now, I think.
That's such an important point you bring up about credit markets and looking at credit spreads as opposed to the level of the 10-year. As kind of a barometer of risk. But getting back to the job story, so the way you're looking at it is, as long as jobs, data, and employment remains soft and softening, this is still a good thing because of the benefit to the overall economy from lower interest rates and the expectations of rates coming down.
Yeah, think of it as a macro normalization that allows the cycle, for lack of a better word, to cycle. Business cycles aren't just bookended by recessions. We can have a cycle in cyclical data, and you can look at PMIs as an example of this, that can have accelerations and decelerations without recessions. There's been periods in time in the 90s and after the GFC where things like the ISM, or even the profit cycle, the growth of profits, has accelerated and decelerated 3 or 4 times over 8, 9, 10, 11 years without getting weak enough to cause a recession. So that is very much a cycle. Just because it didn't end marked by a recession doesn't mean that we're not having these cyclical movements and accelerations and decelerations in the macro data, in earnings data, and therefore also in market leadership.
So as long as jobs remain soft and as long as inflation doesn't spike, we continue to have a Goldilocks backdrop for equities.
Well, yeah, I think it's a question that I think everyone's somewhat, well, perhaps thinking about. I certainly am, in that at what point, or is there a point, and at what point is that, where a weaker labor market and lower rates does not correspond in higher stock prices? It can, in 06 and 07, 08, we saw unemployment rising and housing stocks getting blown out of the water at the same time interest rates were falling. So that was clearly not what we're seeing today. And the question we often get is, well, what level of the unemployment rate do you think you see bad news is bad news broadly for equities? And it's hard to really know. It's hard to answer that because it's not an exact science. It all has to do with behavior and confidence. And it's hard to understand the reaction function of investors and companies and policymakers is something that can change and is not linear. So instead of answering that question with a specific rate on the 10-year or a specific number on non-farm payrolls moving negative, which we've already had a negative print, I think it was June payroll numbers that subsequently have been revised twice at this point and is now negative. So imagine the market reaction. If we got that number actually back in, I guess, July of a negative number, the market probably would have not reacted positively. But now that it's been revised twice and people aren't really looking that far back, it's not really being viewed as such a big negative. But I don't think the answer can be a specific number. And again, I go back to what we were talking about with inflation. It has to do with expectations. I can't think of anyone right now who wouldn't agree now, finally, that the labor market is soft. I think that was a widely debated data point over the last 3 years. And we've seen broad-based evidence that it's been cooling or softening. I wouldn't say it's contracting or collapsing, but there were plenty of people that were pointing at other data and saying, oh, the labor market's really strong. And again, everyone's got their own lens and how they look at through the data and how they corroborate different data points. But I would say today, more so than any point in the last 3 years, more people would agree with the notion that the labor market is soft and has been softening now that we have revised data. And so the expectations is for more of that, right? And that's what humans typically are, very reference biased. And so they tend to think what has happened will continue to happen. And so that's what we've seen with a little bit with inflation the last few months. And so if unemployment rate keeps moving higher, and I actually think it will, I think what matters is not necessarily the level, it's how quickly it moves up and how persistently it moves up. So last year we had the unemployment rate move up for, I think, 4 months in a row. And by the August payrolls report, which was for late July, early August, that accelerated from, I think it was 4.1 to 4.3. And that's when the market started selling off because you had seen claims go up and unemployment go up. And eventually it shook the confidence of the market. But again, back then, there was a much bigger debate on the health of the labor market than there is today. So what we're watching is our 10% rule, which is looking at the growth rate in unemployed people, which is the numerator of the unemployment rate. That's another derivative of Claudia Sam's rule. She looks at the unemployment rate and the 3-month moving average and its year-on-year change. We're looking at the numerator. And I think it's actually important nowadays, too, because there's a debate around the labor market about, is it supply of labor weakening? Is it demand? Is it both? So I'm more concerned about the number of people that are becoming unemployed in the numerator there. And so we've seen that number, which did accelerate a year ago, almost up to somewhere around 15% or so, which historically has always been consistent with a recession, not this time. We don't have to get into why, but there's plenty of reasons why. And now that growth rate is down to, as of the most recent payroll report, 2.9%. So more simply, the unemployment rate number today is 4.3. A year ago, it was also 4.3. So the number doesn't, to me, matter as much as the growth rate and the expectations. And right now, I think we would need to see a pretty sharp increase in the unemployment rate or persistent negative payrolls reports or really weak ones to really have a sustained material negative impact in the market. Our view, And the economics team that we work with, who's headed by Nancy Lazar and Jacob Bina, we both believe that we're going to continue to see the labor market soften as it has been softening, which again, not most people agree with, but not really fall out of bed or sharply contract. And when I look around the world and look around at markets today, it's really hard to see a major negative macro catalyst now or impulse that is going to really push us over the edge sharply, as opposed to just continue this persistent softening of the labor market. Oil prices are ridiculously low. I was looking at a chart of real oil prices today. We're basically at 20-year lows today. Interest rates have been flat or falling for the last 2 years. And we're starting to see some green shoots in leading economic indicators. And we've seen the broadest increase in earnings estimates in the last couple of months than we've seen in the last 2.5 years. So again, plenty of mixed data, but bottom line is I think the markets have been going up because leading indicators and earnings have been improving and rates have been falling. And these early cyclical stocks, names that typically positively react to falling interest rates, even if it's due to rising unemployment, have been strong outperformers. And all of these data points I just mentioned are green shoots for what we think will be a broader 2026.
So a pretty rosy macro backdrop as we stand here today.
Well, rosy in the context of this cycle. Rosy 10 years ago would have been an ISM of 60, earnings growth broadly booming. Interest rates really didn't have a negative impact when they rose. And that's a big difference with this cycle. And again, why I think there's some confusion from some investors. Why are our stocks rising as interest rates are falling due to rising unemployment? So yeah, and I think the definition of Goldilocks in this backdrop is actually a softening labor market combined with a healing backdrop potentially for housing. And again, we're seeing data that supports that. Refi activity was at a 1-year high this week. The purchase index has been slowly grinding higher. And so this coming week, we will see a ton of housing data. Let me just check it again. I think most of that data is going to be for the month of August, besides the NHB. And so the NHB is going to be the data point to look at. That's the leading indicator within the housing market. That is builder sentiment. And that's going to reflect the more recent drop in rates and give you some insight into where building permits and housing starts, which we'll also get, but that'll be for August. The NHB will help tell us where that other data is likely to be in the coming months. And a lot of things we're looking at suggest the NHB should improve, and it is at a very depressed level. It's pretty much at the lowest levels over the last 3 years. Housing just had this L-shaped outcome over the last 3 years, fell sharply in 22, and it's just been sideways. But when you look at long-term mortgage rates or long-term rates coming down, that tends to lead housing activity, starts, permits, applications for purchases by about 4 to 6 months. So it suggests that over the next couple quarters, we should see the housing data improve, stabilize. And I know housing is very regional nowadays, and there's weaker parts of the housing market in the country. There's stronger parts, but all parts will benefit from this drop in rates we've seen. So that'll be a good litmus test for the macro outlook, because if the housing data over the next few months does not improve on the back of falling rates, which a simple model would suggest, then, we certainly have to ask ourselves, well, why isn't that drop in rates translating to better activity? Because that would be a big yellow flag, perhaps red flag. That's what we saw in leading into the '08 recession.
Better housing would be a great thing.
If there's something that's been missing from this last few years to understand why we've had such a narrow market and economic backdrop, the numerator, of course, it's AI, but the denominator, or the other rest of everything else, it's not only because AI has been so great, it's because there's been some weak activity in manufacturing and housing activity for now 3 years. So if that can improve, that is a game changer for markets.
Well, thank you very much for your insights today, Michael. This was great. We'll all be watching the data next week and see how this economy is evolving.
All right. Good chatting with you, Stephen. Have a great weekend.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.